Welcome back to Radio Free Market. I'm your guest host, Drew Yelm. In studio with me is Zach Halstead, and we are talking with Dr. Joseph Salerno about money, sound and unsound, from gold to paper in the 20th century. Before the break, we were talking about the changes to the inflation calculation real quick. I think you said you had something you wanted to finish up there real quick, Dr. Salerno?
Yes, so core inflation basically removes energy prices and food prices. And then in the 1990s, the index, the CPI, was revised even further by removing housing prices and putting in a rental equivalent of owner-occupied houses, which, again, understated increases in housing prices. And then you had some other adjustments, hedonic adjustments, which means that, for example, if a car now has 4 airbags instead of just 2 airbags, well then, since the car is a higher quality product, well then, if the price goes up by 10%, it has to be adjusted downward because part of the increase in price comes from the cost of the higher quality. So in other words, it's reducing the inflation rate in that respect, below the actual rise in prices.
Yeah, some of those things just sound so ridiculous. Like you mentioned the rental adjustment rate, and I'd read about that where they basically say that if you own your home, they add into the GDP the amount of money that you would pay to rent your own home. Is that correct?
Right. There's what's called an imputed rent in economics. It's a rent that you would pay if you were renting the home. Okay, so those prices tend to rise more slowly. The rents more slowly than the housing prices. And the other thing they do, by the way, just very quickly, is something called they account for substitution bias. So if the price of beef is going up by a certain percentage, they reduce that percentage because they say, well, you know what, people shift to lower priced chicken and hot dogs and so on, so that they reduce the price. They're not paying as much as they would have if they continued to buy the same amount of steak. So in other words, you're not giving the same weight to that increase in the price of steak, for example.
And I'd even read somewhere that some of these hedonic adjustments and other imputations that they make to the GDP, they basically add something like 1/3 to the nominal value of GDP. Is that anywhere near accurate?
No, I haven't seen that statistic.
Okay.
So I'm not sure about that.
Okay. Well, anyway, getting back to after Paul Volcker was the chairman, after that we had Alan Greenspan, and how did after the savings and loan bust, how did Greenspan manage to create 2 back-to-back bubbles? First the dot-com bubble, then the housing bubble.
Well, Greenspan wanted to inflate the economy out of the recession of 1989, 1990. Money was tight there for a little while, and in fact, President George Bush, the first President Bush, and his administration put enormous pressure leading up to the 1992 elections on Greenspan to increase the money supply. And to this day, the first George Bush blames Greenspan for causing him to lose the election, which is an interesting point. But he's actually correct in some sense because citizen voters will look back about 1 year on the economy leading up to the election, and if it's doing well, the incumbent party will not lose votes for that reason. Okay, but if it's been in a recession within the past year, then you lose votes as a result of that. If you're the incumbent. So to make a long story short, it was after that when Clinton came in, and that Greenspan again began to increase the money supply, and eventually by 1995 he made a statement that there was irrational exuberance in the economy, meaning that stock prices were rising too quickly to be justified by the fundamentals of underlying supply and demand forces. But then, sometime in 1996, I believe, he changed his tune and he began to say, you know what, our economy is much more productive because of the high-tech industries and so on, so that these high stock prices are simply reflecting this greater productivity, and therefore we have a, quote, new economy, unquote, which justified the huge bubble that eventually burst in the high tech stocks, in NASDAQ in particular. It collapsed in 1999, 2000, and we went to another recession. And then to get out of that recession, by the way, the second blow to the economy was 9/11, which occurred in 2001. And so Greenspan felt justified at that point in, again, really gunning the money supply in 2001. And what he began to do to justify this, and I think this is a very important way of explaining what occurred in the last decade, was to begin to blame deflation. Okay, Bernanke, who was on the board of governors at the time, gave a speech in November of 2002. In which he said that we're close to deflation. Inflation is much lower than it really should be. It's so low that we're risking deflation. And not many people paid attention to that speech. But then later, a few months later in April, Greenspan began to talk about this risk of too low inflation causing deflation. And so that was a justification for increasing the money supply, or beginning to increase it in 2002.
So, and then they just continued to create more money throughout the 2000s to fuel the housing boom. Is that what?
Yes, right, exactly. They pushed the interest rate down to 1% for a full year. The federal funds rate, which is what the Fed targets, went from something like over 6% all the way down to 1%, and when they held it at 1%. For that period of time. And now people focus on the interest rate, but what's important also is the money supply. And between 2001 and 2005, depending on how you measure the money supply, there were $2 trillion new dollars of money injected into the economy in those 5 years, which is about a 50% increase. And that, just doing a back-of-the-envelope calculation, the Fed was increasing the money supply, if you look at M2 or MZM, at about $1 billion per day. So people ignore this when they claim that it's problems, inherent problems with the financial markets that caused the bubble and then later the bust.
And then just since we've had this continuing housing bubble and the subsequent collapse in 2008, there's been an even more massive amount of monetary creation in that particular point in time. How does that compare to what was done previously? I mean, could you talk about inflation expectations during the first 5 years of the decade versus these last 2 years?
What's happened in the last few years is that the Fed has more than doubled its balance sheet, which means that it's created a lot of bank reserves by buying up not only what it traditionally bought, which was government bonds, treasury securities, but also by buying up mortgages and commercial paper and so on. And as a result of that, banks have a lot of reserves. Their reserves, increased tremendously. But the banks, because of the bad economy, the banks have not been very eager to loan those reserves out. So there has been increases in the money supply, but not of the same magnitude that you had between 2001 and 2005. That's starting to change now. We're starting to see an uptick in the inflation as banks do begin to loan more, and rather an uptick in the rate of increase in the money supply as banks begin to loan more out as confidence is returning to the economy. And I would argue it's a false confidence, by the way. A lot of these rises in prices, in commodities prices, in land prices in the Midwest, we have junk bond prices rising and so on, are the result of the Fed's quantitative easing policy. Okay, quantitative easing 1, quantitative easing 2. And that simply means printing money.
So we've printed all this money in the last couple of years, coming out of the 2008 crisis, but we haven't really seen 1970s style inflation in the United States. Can you kind of talk about the reasons behind this? And I know it's hard to predict the future, but when will this inflation start to actually hit the markets and cause an increase in prices? Okay.
As I said, the Fed didn't directly increase the money supply. The Fed directly increases bank reserves. If the banks don't loan these out, you don't get much of an increase in the money supply. So for the first few years after the crisis, 2008, 2009, the new money did not get into circulation. It's beginning to get into circulation now. And so what you're going to see is prices rising more rapidly. but also there's some confidence returning to the economy. So for a while, it might look like the economy's recovering. You're going to see unemployment still stuck at a very high level, 8.8%. You're going to start to see that fall. But the problem will become how the Fed's going to react when prices begin to increase at rapid rates. And also, by the way, we sort of have, the Fed has restarted a stock market boom. Okay, there's been a tremendous increase in stock prices from the bottom of the bust to today. Okay, so when all that happens, the Fed's going to have a tough decision to make. What should we do? Should we slow down the rate of increase in the money supply? If they do that, then you're going to get basically stagflation. Then you're going to get them fooling around with trying to adjust the money supply, but still increasing it, and prices are going to be increasing, and at the same time, you're not going to get unemployment coming down. You're not going to get factories, putting more people to work and producing more and more. You're going to get a very slow, sort of stagnant economy. You could get sort of a Japanese lost decade of the 1990s. Where you're inflating and you're running deficits, and that's something else that's scaring the American people. But it's not curing your unemployment. It's not putting the real economy back to work.
Speaking of Japan, the yen recently strengthened considerably against other currencies in the wake of their earthquake there. So much so even that the G7 nations underwent coordinated intervention to weaken the yen. What was the rationale behind this? I mean, why did the yen get so big so fast, and then was this a good policy?
The yen got very strong because when the disaster hit in Japan, or the series of disasters hit in Japan, the assets that they owned in foreign countries, they began to sell off. And so they sold them for foreign currencies. Say they held, stocks or bonds in the U.S. And other countries. They sold them for dollars, and they used those dollars to buy yen. So that movement back of capital, that capital moving back to Japan, okay, to help alleviate and respond to the problems that they were having, was what drove the yen up. Okay, so capital was moving into Japan rather than out of Japan. So that was why it drove the yen up. But at the same time, when the yen becomes more expensive, their exports begin to shrink, and their imports increase. So the coordinated effort to drive down the yen may have been to help their export industries, okay, to prevent them from shrinking too much. But that defeats the purpose of moving the capital back to Japan, because what you want to do is you want to basically cash out these assets and buy real goods and services, because your economy has suffered a big blow from the natural disaster.
I kind of want to shift the debate towards China now. So they're one of the largest foreign holders of U.S. Treasuries, and these are, of course, denominated in U.S. dollar, which has dramatically decreased in value this year. And I'm kind of wanting to get your take on how you see this relationship progressing between Beijing and Washington, given the fact that China has repeatedly warned that loose U.S. monetary policy threatens the future of the dollar.
Yeah, China is sort of on the horns of a dilemma, because China, as you said, holds a lot of dollar-denominated assets. So when the dollar depreciates, and is expected to depreciate, the value of those assets go down. So what China could do, and this is sort of the other horn of the dilemma, is to begin to sell off the U.S. assets. But if they sell them off too fast, that's going to cause them to decrease in value, so that the U.S. dollar is going to be driven down even more, and whatever U.S. assets that China still holds will lose value in that respect. So if China were to sell off its U.S. assets, it could really drive the dollar down, and that would cause interest rates in the U.S. to rise, as other foreign investors in the U.S. begin to pull their capital out. So at that point, the burden of financing this huge government, these deficits, these 1.5 trillion deficits that we've had now 3 years in a row, is going to fall on the shoulders of the American taxpayer. So people are U.S. American citizens bash China. The U.S. government bashes China, but the fact that China is willing to buy all of this debt from the U.S. prevents us, as citizens of the U.S., from having to bear the burden the high interest rates that would occur if the U.S. couldn't borrow from the rest of the world, so that we would have less money to purchase houses with, cars with. I mean, the ramifications would go throughout the economy.
And with the dollar, the Chinese acting as a reserve holder of dollars, hasn't the United States really exported a lot of inflation to China, and they're coming to see that nowadays as well?
Yeah, that's a very good point. Because China wants to keep its currency undervalued, it wants to keep a fixed exchange rate between its currency and the dollar. And because we're relatively to China, we have this inflation that's going on, and also the deficit causing dollars to be purchased by the Chinese. In order to purchase those dollars, they have to create their own yuan. Additional yuan, so they increase their own money supply. So now you see a housing boom in China. You see prices going up elsewhere in China, and you see a lot of investment activity in China that's resulting in, for example, cities with no one living in them as you have more and more construction. So China is suffering an inflationary boom as a result of importing our inflation by purchasing the unwanted dollars that are flowing in from their citizens, from the investments in U.S. assets.
And going forward, what else do you see happening, I guess, to completely go to the other side of the Eastern Hemisphere? Within Europe, they're also having a lot of trouble over there as well with debt. The Greeks are starting to default in their debts. The Irish, the Icelandic country, I mean, all these different countries in Europe as well are starting to go down as well with the euro.
Yeah, those are the PIIGS countries, the pig countries. Portugal, Italy, Greece, Ireland, and Spain. They're having problems. Greece has been bailed out. Ireland has been offered a bailout. In any case, what happens is that these countries with historically more inflationary had historically more inflationary currencies in Europe. And once they became, so they had to pay very high interest rates to borrow from abroad, because of the feared depreciation of their currency. So if you're going to loan to a currency to a country that had a very inflationary currency, you would charge them high interest rates. But once they adopted the euro, once they were allowed into the European Union or the European Monetary Union, at that point they were using a currency that was fairly strong, which was controlled by the German Bundesbank, which is historically sort of a very strong currency, the mark had been. And to make a long story short, they then sort of free rode on the backs of the good reputation of
Dr.
the euro.
Salerno, we're coming up on a break here on Radio Free Market, and after the break we're going to continue talking with Dr. Salerno. Please stand by.
Welcome back to Radio Free Market. This is Zach Halstead. I'm sitting in studio with Drew Yelm. Today we are talking with Dr. Joseph Salerno about money, sound and unsound, from gold to paper in the 20th century. Before the break, Dr. Salerno was giving us his view on Europe and the reasons for their continuing troubles with their euro-denominated currency and how this affects their member countries.
Yeah. So the weaker countries like Greece and or the countries with the weaker currencies that now had the strong euro could now borrow at lower interest rates. So basically, they ran huge fiscal deficits because they could borrow from abroad to finance these deficits, and that resulted in inflation. That resulted in out of control government spending, and so now they can't pay their debts. So they're seeking bailouts from the rest of the European Union.
So, Dr. Salerno, throughout this discussion we've had today, we've kind of been talking about how the world has shifted from free market principles to more interventionist principles, and it seems the world has grown more accustomed and reliant on this government intervention in recent years. How do you think this attitude shift will affect the structure of the world's currency system in the future?
Well, reality is intruding here. I mean, there is the shift in ideology. There has been a shift in ideology, as you said, towards more interventionism. But I think there are signs that might be tempered by what's going on, and that is that the euro is collapsing, the dollar is depreciating, it's not fulfilling its role as reserve currency, safe or a safe haven where people during times of stress in the world economy would invest in dollars. So that now you've heard in the last year talk, by the World Bank, by China, Brazil, of include getting rid of the U.S. Dollar as the sole reserve currency, and maybe substituting a basket of currencies, which would include gold. And we've had talk of some sort of a gold standard, or targeting the price of gold on the world level, not a true gold standard, of course. So I think the economic problems that we're having are causing people to reassess this interventionist philosophy.
Well, and what do you see the solution is to this mess? I mean, how can we transition back to a real gold standard, or a system of competing currencies taking the power to inflate away from the state?
Yeah, I think that has to be done, for example, in the U.S. I mean, we can do that alone, and I think the first step is what you sort of mentioned, competing currencies. I think legal tender laws should be abolished, and all taxes, excise taxes, sales taxes, capital gains taxes on gold and silver should be removed, and also any regulations that prevent U.S. banks from offering American citizens accounts in denominated in foreign currencies, or even accounts in gold and silver, and because the people who have done that have been prosecuted under the counterfeiting laws. So once you remove all these legal barriers, I think then people can pick and choose what sorts of things they want to use for their medium of exchange, and that will put a lot of pressure on the Fed. Even if you don't go back to the gold standard right away, they'll put pressure on the Fed to stop the inflation. So I think that's the first step back.
All right, well, we are coming up on the end of the show here on Radio Free Market. I'd really like to thank Dr. Joseph Salerno for being with us today, and if you have any last words.
Well, no, my parting words would be that the ultimate solution to the currency problem is to go back to the gold standard. I think the U.S. can do that alone over time, and that other countries will naturally want a stable currency to tie on to. So I think that is what we should be looking forward to, and that's what we should be trying to educate people about.
Again, thank you so much, Dr. Salerno, for being with us here today on Radio Free Market. This is Drew Yelm and Zach Halstead and Radio Free Market. Please visit us on the web at radiofreemarket.com, where you can subscribe for free to all of our shows on iTunes, or visit our Radio Free Market archives for easy downloads. Also, check out Mises.org, where you can find more work by Dr. Joseph Salerno, and also, to check out his book, Money, Sound, and Unsound. Until next week, wherever you are, please stand up for freedom. Thank you for listening.